Every now and then, I hear the comment that index funds result in over-diversification. The thinking goes that instead of buying all of the companies in an index, you might be able to focus on a smaller subset that you believe will perform better than the market as a whole. It makes sense. Of course, you can't beat the market by holding it. The problem is that decreasing diversification leads to a wider range of possible outcomes, with a disproportionately large probability of a negative outcome relative to the market. I'm Ben Felix, Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you why index funds do not lead to over-diversification. Before I get into the episode, I wanted to take a moment to thank all of you for watching and subscribing. I didn't really know what to expect when I started making these videos 2 years ago, but the response has been excellent and it feels like there's a great community building around the channel. To talk about over-diversification, I need to introduce something called dispersion. It is the size of the range of returns observed for an investment strategy. If an investment strategy has high dispersion, we would expect the actual result realized by an investor over a given period of time to fall in a wider range of possible outcomes above and below the expected value. Another way of thinking about high dispersion is that your outcome is less reliable. Even if you have good reason to expect some amount of average long-term return, high dispersion means that you are less likely to get it. On the other hand, a low dispersion of outcomes means that your actual result is more likely to be close to what you expected, or more reliable. Now, to be clear, if your goal is to knock it out of the park and make massive gains by picking stocks, then you want high dispersion. This doesn't mean that you're going to get your desired result, but to have the potential for massive gains, you also have to accept the potential for massive losses. That is what you get with higher dispersion. For any long-term investor who's hoping to meet their financial goals, as opposed to trying to knock it out of the park, a low dispersion of outcomes is much more favorable. The relationship between the dispersion of returns and diversification is important. In 2006, an academic definition called active share was introduced to examine the concept of intentionally under-diversifying relative to an index in an attempt to add value. This is how traditional active management works. Active share measures the extent of active management being used by a fund manager. Stated differently, active share measures how different an investment strategy is from the index. When someone says that index funds lead to over-diversification, they are effectively saying that you should invest in something less diversified, with higher active share, in order to do better than the index. In a 2012 paper, Vanguard looked at the dispersion of outcomes for actively managed mutual funds alongside their level of active share. They found that as active share increases, the dispersion of outcomes also increases. This is exactly what you would expect. When you hold a subset of the index, you're going to get a result better or worse than the index. And the more concentrated the strategy is, the wider that possible range of outcomes will be. A 2018 paper from Dimensional Fund Advisors took a different approach to assessing the importance of diversification. I'm going to pick on dividend investors for a moment here. If you remember my video on dividend growth investing, I explained that dividend growth stocks, on average, have market-beating performance, which is mostly explained by their exposure to the value and profitability factors. Factors are risk-based premiums that explain differences in returns between securities. For example, value stocks, on average, have higher expected returns than growth stocks. Stocks with robust profitability have higher expected returns than stocks with weak profitability. Exposure to these factors is what explains the strong past performance of dividend growth stocks, not the magical dividend fairy. This is important because factor exposure can be attained with a diversified portfolio that includes both dividend-paying and non-paying stocks, as opposed to individually selected dividend-paying stocks. The importance of this will become even more clear in a moment. The dimensional paper that I mentioned took an index of 2,637 global large-cap stocks with an emphasis on the size, value, and profitability premiums. In other words, it is a global large-cap index that has been adjusted to have more weight in the smaller large stocks, large value stocks, and large profitable stocks relative to the market. They tested it against the MSCI All-Country World Index from 1994 through 2017. They found that the adjusted index beat the market index by an annualized 0.8%. To test the effect of diversification on the reliability of this outcome, they sampled portfolios with 50 stocks, 200 stocks, 500 stocks, and 1,000 stocks selected from within the adjusted market index. Each of these sub-portfolios was constructed to have the same average excess return as, and similar volatility to, the adjusted market index in its full form. Phrased differently, the sub-portfolios look the same as the overall adjusted index from the perspective of expected returns and volatility, with the main difference being their level of diversification. Despite the sub-portfolios being constructed to have the same excess return and volatility, the dispersion of their returns increased with each reduction in the number of securities in the portfolio. Due to the increase in dispersion, the authors found that while the probability of the full adjusted index beating the MSCI All-Country World Index over 5 years was 92%, the clone portfolio made with only 50 stocks had a much lower 63% probability of beating the market index over 5 years. This should make it clear that my example of a dividend investor hoping to capture the value and profitability premiums, which are what explain the excess returns of dividend stocks, while holding only 20 or 30 stocks, is in for a wide dispersion of potential outcomes. They may do really well, as I know some dividend investors have, but they may do really poorly. There is no way to predict the actual outcome that any individual with a concentrated portfolio will get. Dimensional ran this analysis in the context of their investment products, which own the market as a whole, while targeting stocks with higher expected returns. But their finding extends to a traditional index fund as well. Capturing the market premium similarly requires broad diversification, where more diversification increases the reliability of the outcome. To me, this finding is both intuitive and profound. We know that it tends to be a small number of stocks that drive most of the market's returns. So without the ability to predict the future, of course you need to hold all the stocks to get an outcome similar to the market. It also tells us very clearly that if a reliable outcome is the goal, there is no such thing as over-diversification. I mentioned that we know that a small subset of stocks drive most of the market's returns. In his 2017 paper, Hendrik Bessembinder found that 58% of common stocks in the US have underperformed the T-bill rate over their full lifetime, and the entire gain in the US stock market since 1926 is attributable to only 4% of the stocks. In their 2015 paper, Heaton, Poulsen, and Witt constructed a simple model to illustrate why this matters. Let's say we have an index consisting of 5 securities, 4 of which will return 10%, and 1 of which will return 50% over a given time period. Active managers will create portfolios using an equally weighted subset of 1 or 2 of the available securities. Based on this, there will be a set of 15 possible actively managed portfolios. 10 of the 15 portfolios will earn a 10% return due to omitting the 50% stock, and 5 of the 15 portfolios will earn either a 30% return or a 50% return due to holding the 50% stock, depending on whether it is a 1 or 2 security portfolio. In this example, the mean average return of all active fund managers will be 18%, while the median return for the active managers will be 10%. 2/3 of the actively managed portfolios will underperform the index due to their omitting the 50% returning security, which is always included in the index. The index portfolio containing all of the stocks will return 18%. The surest way to avoid the relatively likely bad outcome of the active managers is holding all of the stocks in the index. We know from the research on active share that less diversification relative to an index results in a wider dispersion of outcomes around that index. It is absolutely true that less diversification offers the chance at a better outcome, but it also offers the chance at a worse outcome. We also know that capturing the risk premiums that stocks deliver over time becomes less likely as we decrease the number of holdings in a portfolio. Finally, the concentration of stock returns in a relatively small number of stocks means that there is a disproportionate risk of trailing the market as opposed to beating it by intentionally reducing diversification. If your goal is a reliable outcome, which seems like a sensible goal for any long-term investor, I do not think that index funds are over-diversified. Has anyone ever told you that index funds are too diversified? Tell me how you responded in the comments. Thanks for watching. My name is Felix of PWL Capital, and this is Common Sense Investing. If you enjoyed this video, please share it with someone who you think could benefit from the information. Don't forget, if you've run out of Common Sense Investing videos to watch, you can tune in to weekly episodes of the Rational Reminder podcast, wherever you get your podcasts.